This is a case study video on comparing an infinite banking policy with a 20-year term policy return of premium. Now there's several people out there that like to sell return of premium policies. That basically means you have a term policy for 10 or 15, 20, in some cases even 30 years, and at the end of that period of time you get back all the money that you paid into that term policy, so that well, you're made whole financially. You don't have any insurance at that time, but you have all your money back. Those policies can be quite expensive depending on how old you are and how many years you take them out for. If you're young in your 20s and 30s, then the difference in price between a regular term and a return of premium is not as much, enough, but not as much. But you get in your 40s and 50s, and that return of premium is very expensive. So I have a person that came to me and showed me this illustration that you see right here. This is with State Farm, and you can see it's a $400,000 return of premium 20-year term. It has a waiver of premium disability, which means if you become completely disabled, it pays a premium. That is $92. So total price is $921 a month. We go down here and we see the return of premium over 5 years, 10 years, 15 and 20 years. At the end of 20 years, this person has paid $217,890 into a term policy. Can you believe that? It's a lot of money. But they get it all back. So problem is you're out that money while you're paying into it. So and this is a tobacco rating, so that's part of the reason why it's expensive like that, but nevertheless it's a lot of money. So there it is, 20-year term, $921, and you get $217,890 back at the end of the 20 years. Well, let's take the same amount of money, let's say $900, okay, and let's take it out for 20 years. And let's have a $400,000 death benefit. So there's the parameters. $400,000 death benefit for 20 years, and then you stop payments and see where the cash value is at the time. So let me bring up the other illustration, and here we are. Now we've got you see here, it's a $400,000 death benefit. We designed it so the $100,000 base policy, and we've got $300,000 into a term rider, basically. So we have a total of $400,000 death benefit. You see here the premium of $10,800 a year, which is $900 a month. Come over here at the end of the first year, there's $404,506 of death benefit. In the first year alone, total cash value, we put in $10,800. We have $7,139 of death benefit that's available to the client to borrow. And that goes up. It almost doubles the next year, and it keeps going up from there. All the way through the 20th year here at the bottom of the page. You see the death benefit continues to go up every single year. On that, we have the dividends increasing every year on this column, and we have here the amount of term. So the first year we're looking at $283,000 in term. At the end of the year, that amount goes down. Why? Because the cash value in the base policy goes up, and as a result, the death benefit goes up. You need less and less term rider, And then by the end of the 20th year, it basically, as the last year, you will have a term rider. But let's look here at the end of, here's the total cash value. Let's look at where it's at 20 years. $265,000. Well, what did we say that the client would get back on the other policy? $217,890. So we've paid in $900 a month, and to this policy, and now we have $265,000 of cash. So what would happen if this client says, I'm going to just terminate this policy and take all my money? It walks with $265,000, much better than the $217,000. And you have a $480,000 death benefit, better than the $400,000 death benefit you saw on the return of premium with State Farm. But it gets better than that. We have here in year 21, now this policy is paid up. What exactly does that mean, my friends? That means that no more premiums are paid, and not only that, there are no more costs coming out. So you're sitting on $459,125,000 of death benefit at the end of year 21, and there's no cost for that. That death benefit has no cost. The cash value here continues to increase every single year with no cost. In other words, this policy now is generating cash. And you got to understand, folks, this policy is just throwing off cash, pure cash. It's a cash producing machine. There's no cost. It's like I pay you money and you don't owe me anything for it. Okay? That's what it means. Every single year, the cash value continues to increase, and every single year, the death benefit continues to increase. So now this client has options. Instead of getting to year 20 and getting all of your money back and having no insurance and having really no say-so about it, here he says, well, I want all my money. Take your $265,000. Thank you very much. There's a little bit of consequence in taxes between the 217 or whatever, 20 times 10,800 and the 220 and the 265, but that's okay. You still have all your money back, and more than the other scenario. And also during those years, your death benefit was increasing. You didn't stay at $400,000. Or you say, well, you know what? Because you never know what's going to happen over the next 20 years, right? You might say, you know what? I think I'm going to keep this life insurance policy. I don't need this money right now. If I do need some, I can tap into this $276,000 at the end of the 21st year. I can borrow from it. I might decide, you know what, I'm retired. Maybe I will buy distressed property and fix it up. So you borrow against this. Hey, look, I've got an opportunity to buy this property for $100,000, fix it up for $30,000, and sell it for $160,000. Guess what? Come over here. You've got $276,000 of cash. Why not just borrow from it, buy the property, pay a contractor to fix it up? Don't do it yourself. Gets done quicker. And turn that property around in 3 or 4 months. Pay your policy back. Meanwhile, the policy's still earning interest. It's not like they take the money out of your policy and let you borrow it. No, they give you the money. You pay them a 5% interest rate, which is better than paying a 10 or 12 or 13% hard money loan for that, and you just pay your policy back. And that's good. It's good to go. Or let's suppose this client keeps on with this policy and he's, 85 years old and needs to go into long-term care. Well, now there's $503,000 in costs, in cash value that they can use for long-term care. Or get this. See over here in year 20, there's $265,000 of cash value in this policy. You could do a 1035 exchange into an asset-based long-term care policy. It's based on a life insurance policy, but you can get up to 5 times as much in long-term care benefit. So you're looking at 265 times 5. That could provide you well over $1 million in long-term care benefits and still have a death benefit. In other words, that 265 goes over and it might pay like $350,000 in a death benefit, but pay you 4 or 5 times that much in long-term care for life, even if you needed to. So, and I can go on and on with the different options that are available here, but you get the point, folks. Hey, if they need cars in retirement, they don't have to worry about going to the bank. Just borrow from here, pay it back. Meanwhile, their cash value keeps going. It's better than taking cash out of their retirement money and paying for a car, which is going to be worth nothing 5 years later. Borrow from their policy, pay it back. The interest they earn is going to be more than the interest they pay on the loan from the insurance company. So borrowing from their policy and paying it back continues to grow their assets. So folks, it doesn't make a whole lot of sense in this particular scenario to get a term policy with return of premium. Now this can work for someone who's not a smoker. It could work for someone who's 40 years old and just wants to get an insurance policy with a return of premium. In most cases, if you take the premium for that return of premium term policy and design a properly structured infinite banking policy like this, more than likely you could come off way ahead of the game by using this whole life policy. Again, has to be taken out with a mutual life insurance policy using paid up additions riders and minimizing the money going into the base policy and maximizing the money going into the paid up additions so the policy accumulates a lot of cash value. And that's it, folks. I hope this has been helpful. And hey, if you need any help or about seeing if an infinite banking policy would work well for you, please give me a call. I'll be happy to help you out or just coach you on it, give you all the information you need to make the right decision. God bless.